Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and we have an excellent program today. A little housekeeping. We have over 100, roughly 110 people signed up, so we'll have to use chat. So basically use let's see, is it the chat or question we actually use?
Question and answer.
Well, there's a Q&A button, and just click on that and type in your question, and then we'll feed the question to our speaker. Uh, Welcome. We're looking for volunteers. Anybody that would like to help the board out, please get a hold of myself or any of the board members if you're interested in doing publicity, finding speakers, or any of those activities. Has been mentioned, we will be recording the first speaker, but not the second. And that's because almost all the banks will not allow you to record recordings, and that's the reason that's being done. I'd like to welcome all of the members across the country. We have uh, members from San Francisco, and we have people on the East Coast that sign up with the Zoom type meeting. It allows us to have the freedom to do that. So I'll begin. Our first speaker is Kristina Kuprina. She's CEO and Chief Economic of Sequoia Wealth Managers. Her topic is Managing Wealth in 2026, Unlocking Financial Confidence in Any Market. And when I talked to Christina about this originally, my intent was we'd have a program where we could have people look at what goes on and not get overly disturbed and have a mindset of we want to make money in the market. We don't have to have everything or do everything right. And that's exactly what she has put together. I'll read a couple of sentences from her presentation description. How to know if your current strategy is the best one for you and your specific plan. Take control of your financial future with clarity and purpose. And in this powerful session, she's going to be presenting a lot of detail on that. Uh, and I'm going to read another comment from her what attendees should learn, how to invest when you don't know the future, and what data really matters. Christina's biography was given as her highest intention is to be of service to her clients, their families, and the community she serves. She founded Sequoia Wealth Advisors to help others achieve financial consciousness, awareness, and understand how financial decisions affect the rest of your life. Uh, Thanks to her financial expertise, her passion for service, and her knack for clear, direct communications, her client relationships are long and successful. So with that, Christina, you've got the chair. I'm looking forward to your presentation.
Oh, thank you. I always enjoy doing these. It's really fun because there's all those people out there that are doing their investing, and each person's journey is uniquely different. Everyone's time horizon is different. And so the intention today, since I can't give specific advice, is what any individuals should do because I don't know you and I don't know these important factors. I wanted to share some ideas and information that will help inspire you to creating your best financial plan and looking at it holistically beyond the portfolio. So that being said, just very quickly, I'll give you a little background on me so you know, I believe I know what I'm talking about. So I've been doing this well over 30 years now. And I started off as a trader and a portfolio manager and an economist. So the economy is a big part of my life. It is not just a job. I think it's kind of very much when they mention it is really a passion. I absolutely love how all the components fit together and being able to present that to other people. So that's it. And as you mentioned, the reason Sequoia was founded is simply because I wanted to create a firm where there was nothing to sell. It was like a menu of services, and you just pick what you want, and that's what we do. Because I don't like selling stuff, and also everybody needs something different. You know, sometimes people are like, I just want tax strategy, and you can do that. However, you have to look at everything holistically, and that's what I'll talk a little bit about today. Before I start, one piece of housekeeping, please send your questions in. Do not wait till the end. Do not wait to see if I'm going to cover it. There's three major topics today, and I can also talk about the economy, about what's going on in the world if you have an interest in that and time permits. So whatever is most valuable to you, whatever questions you have most valuable, please send them in. I'm going to break and check for questions throughout the presentation. I'm just trying to minimize an issue where it's the end and our time is coming short and there's a whole bunch of questions and I can't get to all of them. Final thing is if you have any follow-up questions, please send it out to the AAII team and I'd be happy to follow up. So that's the idea. So just in case later you're like, oh, I forgot that question, just send it to the AI. They'll send it to me, I'll give an answer and they'll get it back to you to keep your confidentiality. So that being said, let's hop into it. So as Lynn mentioned, a really big part of this is really looking beyond just the portfolio and the performance and understanding some of the bigger impacts that can often happen when investing. And there's tax components, of course, but there's also highest probability of success to your stated goals with enough flexibility to change as life changes. Now, sometimes life is market cycles. The economy is very much like the seasons. We have winter, we have spring, we have summer, we have fall. You want to know where we really are based on data. And that's one thing it's very important to understand. So there's a lot of noise, especially in the media, especially with people presenting a certain narrative. And sometimes it can be challenging to see what is really important. What does this really mean? So there is a number of data points that are most valuable, though sometimes it gets challenging. Like the BEA, which gives us our employment and labor data, recently changed their process, and they share it with us. So it's very transparent. We know what they've changed. There's no mystery meat in it. However, it does change data. And so when you compare old data to new data, sometimes like, oh, things are getting better, things are getting worse. Well, sometimes it's also when they periodically, and this has happened for years, right? They adapt the methodology to determining this data to understand, like, from the economic cycle, what is really valid and important. And I'll just give you a really big example. In the United States, 2/3 of our economy is consumer spending. 2/3. Can you believe it? Not the government, not businesses, consumers spending money on goods and services. That is the biggest driver of our economy. And so a careful point that I watch is whether employment is growing or shrinking, what is happening is the labor markets are in the fours, which is the historical normal. It's where we are now. And also, two, are wages rising faster than inflation, right? Because that means the consumer has capacity. I'm not saying this would be all and end all because it does tie together with other data points that are out there. But that's the one thing to keep in mind. You'll hear this and this and this, and a lot of data points, especially monthly ones, can get really noisy. So what we do is we extrapolate that data over a long period of time, see where are we in relation to historic norms and what season are we in now. So for you as individual investors, the season matters more if you're close to your distribution time. I always call it your start date, when you're going to start to take money from your investments. Now, there's two pieces to that as well. If you have retirement accounts, and especially for you in the glorious state of California, you got a big tax consideration there. And I'm going to talk a little bit about more taxes in a moment, but that really needs to be factored in the plan. You have a $5 million portfolio and you're in California, you really don't have a $5 million portfolio. This is a reminder. Because the taxes, and depending on what tax bracket you fall on distributions, all distributions from non-Roth retirement accounts, 457s, 401ks, IRAs, etc., are taxable at ordinary income. Now, it does, of course, depend on your state of residence and other factors as well. But I was using California because I get a sense that's where the bulk of everyone is. But each state will be different. So this is one important part of your calculation when you're determining the sustainability of distributions is really making sure to factor in taxes. Another consideration with retirement accounts is, again, depending where you are in your life cycle. So right now I'm starting with people close to goal or are getting to distribution stage, is also what you could potentially experience what's called the tax cliff. And this is why in financial planning is more important than portfolio planning. Because to understand that. So using that example of $5 million portfolio, and you only need, $50,000 of income, you don't want to take more, then you can find yourself in this tax cliff when you hit 73 or 75, depending on your age. So 73 for those close to goal. All of a sudden, you're forced with the required minimum distribution to take out more money than you need, and then more of it's lost to taxes. Now, there are some strategies around that, like charitable giving and whatnot. So there are some ways to potentially minimize it, but this is important things to understand. So market cycle. Oh, I'm sorry. I want to add one more thing. For non-retirement accounts, the holy grail of investing is to be able to live off of your income, the income the portfolio is generating. And that's where things get super fun because you can say, okay, this much in equity, dividend income, taxed at 15 or 20%, depending on your bracket, and this much in, again, picking on California again, California municipal bonds for tax-free income, because you're going to get the same income more tax advantaged. Also, if your income drops significantly on retirement, do we look at doing Roth conversions on some of these as well? Because what will happen with the Roth conversion is in the future, that's another bucket you can pull from tax-free. So the idea is that I'm just going to make up a number here. You need $100,000 a year. Let's try and get you in the $40,000 a year tax bracket. It helps because a guaranteed loss is taxes. It's just a reality, right? Now, we all have to pay them. It's part of life, but do so mindfully. Being aware of what your options are. But that holy grail is getting to that. And then to complement your income, if you're getting the dividends from your stocks, which you're taxed on whether you're taking them out or not, that's a source of income. And it continues to grow over time, the portfolio. Market volatility doesn't bother you. As long as there's no major dividend cuts in the holdings you have, it's amazing. And you're not eating the seed corn, right? You're just continuously getting this income. Potentially complicate, again, I have to remind you, none of this should be construed as direct investment advice per our regulators, and the fact I really don't know what's best for any one of you. Ideas for consideration. But a municipal bond portfolio in the high tax states, New York, California, etc., can sometimes be very beneficial because that's another source of income without a tax consequence. So bringing that all in together with these pieces of I've been doing financial planning a long time now, and I have found time and time again that proper allocation within the buckets, right? How you do the organize it is more important than portfolio investment selection. Because the markets obviously don't have certainty, but this does have certainty. It's a moving target. Tax law keeps changing. I want to start with that as like the high level of understanding. So for the younger ones, a little bit further away from goal, okay, there's let's say there's two groups. There's really young, heck, grow as much as you can tolerate the volatility. There's a lot of consideration on that, but this is not money you're touching anytime soon. Again, assuming they're retirement accounts. If you have another account, let's say an investment account, maybe you're going to be using that for a home purchase or some intermediate term thing before retirement, then the allocation with that will be different. Let's say you're thinking, oh, I'll look at buying a home in 5 or 10 years, would be a different allocation than I'm on Zillow. I'm ready to go. We're looking. You want to make sure to back that risk down. No matter if the markets are flying, it doesn't matter because you need stability there. You need that down payment. So the time horizon is really, really important even for younger people of when are you planning to touch this money? And also how much volatility can you accept? And the important thing to do, what I do with my clients, is I don't just tell them, oh, normal volatility, market extremes, moderate portfolio, 30% down. Most people don't get percentages. You guys probably do because you're individual investors, but many people do not get percentages. So I tell them dollars. I said, if you log into your account and you see this number, this is normal in this strategy. This is normal. And can you look that in the eye and accept it? And if they go, ooh, then I say, well, we want to rerun this and see, because what you don't want to do is ever panic, right? Or get in fear. And, as we were actually chatting beforehand, the reason the average investor doesn't do well in the markets is mostly because of emotional decision making. Or they read something on the media and they're like, but that's most because once you get out, even if you were right in the short term, getting back in, the average investor takes 303 days. And they experience 40-something%, or an exact number, 47% less growth than someone who stayed in. This is time and time and time and time again. So timing the market, trying to guess the market Generally, I mean, trust me, I've been doing this a long time. If it did work, I'd be doing it. Knowing the seasons works, knowing your needs works, your time horizon, your financial plan works, but guessing what's going to happen day to day is much more challenging. I'll say one last thing. Oh, sorry, go ahead. Questions?
Or 3 questions pending. Where do you service clients?
Where?
Is it all US or?
All over the country. I'm actually sitting in Nevada right now.
The second one was a request to talk about the economy. The third one is how does covered California premiums get affected while doing Roth conversions at age 62
Mhm.
before taking Social Security?
Okay, I'll start with the Social Security one first. I'm going to go backwards here. It does have an impact, and that is a moving target because they keep changing what the numbers are. So if this individual, that's us, is, again, I have to ask a question back, but I'll give you two different scenarios since you can't answer me. Do you have a tax advisor? If you have a tax advisor that does planning, my suggestion would be right after tax season ends here that you schedule a meeting with them and run this in your specific situation. It's very important to get in your specific situation because there's a lot of different types of income that impact covered California that will be different for standard tax planning. But that is something really, really to look at, and it's very important. But it's best to be done individually, either with financial planners like us. And again, I'm not here trying to be self-promotional. There's other financial planners that work on a fee basis as well. Financial planner can do this for you. However, your tax advisor can also do it if they do strategy. If you're doing your own taxes, if you're using TurboTax or some of the other tax software, you can actually play with it in the system, and they're pretty good at guiding you if you get stuck on anything. So I'm really making sure I'm giving options, self-directed with or with assistance. But that's very important because again, we're not knowing all your sources of income and how that plays out. It's hard to tell where that's going to hit you, and that's going to be personalized planning for sure. I will talk about the economy in the moment, and I apologize. The first question again?
Oh, that was just where you handle clients, which is
Oh,
all of the
okay,
US.
that's why I forgot. I already answered it. Yes, all over the place. In fact, I start at 5 in the morning, so I love it. I could talk to people in Europe, and I could talk to people in the East Coast, and roll into West Coast time very efficiently.
Thank
Um,
you.
you're welcome. So I'm kind of going very high level, so I'm going to go into a little bit more about the tax and portfolio aspect, and it's sort of some ideas and thoughts with that. The most important thing, and this is what I would say to individual investors or to anyone, is some form of financial planning. Because what financial planning does is it holistically looks at everything and it updates regularly when tax law changes. So last year we had a really big tax law change. Really, and trust me, I'm in tax season right now. It's really busy because there was so many changes. Most all of them were positive. Most all of them, the highest income people got hit a bit, especially with charitable giving. But for the most part, for people making less than $150,000 a year for a couple, 75 individual, that's been beneficial. So but that's depending on the future of the elections, that could potentially sunset in the coming years. So to be able to have a plan that adjusts for tax law change is important. You can't just do a plan and stick it in a desk somewhere because it needs to be a living document essentially. But the planning looks at tax strategy. Like for us, we look at your tax return. I'm like, oh, here's some stuff you can do differently. A lot of CPAs are not strategists. They just fill out the forms. Now they say, send me all this information. They come back and say, here's how much you owe. It's very important to have that strategy. I know when we do this report for our clients, their CPAs love it. Like, oh, you just made my job easier. Yay. And it's also explanatory. It's like, if you do this, this is the benefit. Do this, this is the benefit. But understand your taxes and understand the analysis of these different decisions. So like the Roth conversion, that the question came earlier, you do want to look at everything because remember, the conversion is taxable income. Does that bump you? Does it also put you in a big tax hit? You want to know before you do it. So all decisions are based on other decisions, and then it's distilled down to highest probability of success with the flexibility to change. But look at taxes. Another one is if you're still working, but you're getting close to retirement, I love looking at workplace benefits. A lot of companies now have things that you can buy within the company that are portable. You can keep them after. And areas that usually have interest in this is long-term care. So long-term care insurance, if that's something that is part of your plan and you're looking at, there's a lot of different ways to do it. I won't go too far in the weeds with that now. But one thing about workplace plans, if they're portable, they're generally cheaper. Depending on your age, there may be no required medical check because you're in the group plan, so to go through all that process. But that's so nice. And I can tell you stories of clients that got that and really needed it, and they were grateful. So we always want to look at, before you retire, what is available in your workplace that may be beneficial to you. Going into that a little bit more detailed is also what is most important to you. So before doing any planning, really important that you look at this kind of hierarchy. And the most important thing is, what is your perfect life? I know it sounds fantastical, right? But how do you envision? You don't have to know everything you're going to do, everything you're going to spend, figure out all of retirement. That's not necessary. But the idea is, what is your highest purpose? Is your highest purpose helping your kids? Is your highest purpose traveling and exploring? Is your highest purpose just knowing that there's financial stability regardless of what happens, or a combination? But because everything goes, because there's always trade-offs, right? There's trade-offs. If you do this, they could be beneficial, but what are you willing to accept to get there? And that's really important. It's very deeply personal. It's very deeply personal. What is most important? I would say pretty consistently, financial security is a big one, regardless of net worth, regardless of goals overall. It's just knowing that the money's there, even with an uncertain world. And the world's always uncertain. It may feel more uncertain sometimes than the others, but it's always uncertain. So it's good to have that plan in place. And then that distills down to the next level, which is the portfolio constructions, which is your area of expertise. So as you probably all know, again, I don't know everybody's experience and strategies. There's a lot of different ways to manage a portfolio. You hear somebody saying, I got the perfect portfolio, it does this and this and this. It's perfect for them. It may be useful to you, but it's perfect for them. It's just like, eating and health and diet and all the rest of that. There's no one size fits all. And so looking at that and saying, okay, what you want to know is highest probability of success. The other thing is the structure of the account. Things that you would do in a retirement account when you don't have to worry about taxes until distribution. You could be more active and tactical with the trading. In a taxable account, you have to be mindful of realized capital gains. And so there's a lot of factors depending on the type of account. What is that allocation? Do you have a concentrated stock position because you've worked for a company for a long time? I always go through cycles. When a company stock does really well, we start getting a lot of clients from those companies. So now it's the NVIDIA stage. Before it was Meta, it's been different companies. And it's like, what do I do? If I sell it, I get killed in taxes. I'm like, oh gosh, well, there's tons of strategies. Don't worry about it. But you want to be mindful of balancing out the risk of that concentrated position in your specific plan, but also what strategies you can employ. Donor advised bonds, option strategies. There's a lot of ways around reducing concentration risk in a tax efficient way. And that's good. It comes back to the taxes, right? And when you do that, there's different vehicles, right? There's individual securities, there's ETFs, there's mutual funds, and then there's what I call the alternatives, private equity, commodities, etc. There's a lot of different ways to do it, and what you do depends on your comfort level with what you're investing in. Some people are a real options geek. They're totally cool, doing options. Other people are like, no, I think I'm going to have someone else do it for me. Like, that's not my thing. And so you'll determine that on your own as an investor, how active you're going to be and where your areas of passion expertise, as opposed to someone that's more passive. I buy good dividend paying stocks for the long term for income, and I periodically rotate in and out of companies. That's the strategy. There's no right or wrong to that. The only consideration there, I say, is tax efficiency and highest probability of success in the goal. Let's see if I have time. I'm going to start heading over to the economic aspects, but I want to take a break for questions.
No new questions.
Questions. Okay. It helps when I have questions because I know what's most important to everybody. The challenge here to me is that I'm used to being more specific with my recommendations, and in this forum, I have to be more general. So please, if something comes up later on, let me know. Other things for the investments, especially related to taxes. Again, that earlier question really targeted. what taxes, you can say, oh, well, it's only going to be this much in taxes. But if it triggers higher things, like now you have to pay the 3.8 Medicare tax, or in California, the mental health tax, another 1%. So you can track up very high end taxes. A common mistake I see, and this is probably less, for individual investors, but someone who doesn't have a financial planner or have any guidance, they say, oh, I'm going to retire and sell my house and move close to the grandkids, right? Well, they say, oh, I sell my house, I'm going to make $1 million, right? Nope. Now you're in the big tax hit. So you just want, doesn't mean you don't do that, but you want to understand what that's going to look like. But it can also blow up your Medicare premiums if you're on Social Security, right? Sorry, if you're on Social Security, Medicare premium aspect, it can blow up other areas of your tax life, and all of a sudden you think you have $1 million, but you probably have closer to $50,000, $60,000 if you're lucky, and that um, excuse me, sorry, 550, $600,000. That is the elements that planning takes into account. Nothing is in isolation of anything else. And the closing to this part of it is I go back to what is most critically important. Highest probability of success for your stated goals. For our clients, we're analyzing probability of success in the plan. Every time we make a decision, every time the client makes a decision, we run again, probability of success in the plan. And it's very detailed. And the reason for that is that some people want a 95% certainty it's going to be successful. And they're willing to position accordingly. And other people are like, I'm good in the 80s. So it's very personal. If you have a defined pension, or something, anything, it doesn't matter, an annuity, anything that provides some form of guaranteed income beyond Social Security, you may be able to take more risk with your investments, right? Because you say, okay, my essentials are paid by guarantees. Let's let this grow. I'll use it for travel and it goes to the kids. In other situations, it's like, all my money's in my 401k. So that's a very different strategy that you would employ as well. And the bucketing within your accounts is very important. How much of it should be more conservative and stable? How much of it should be more moderately invested? How much should be focused on growth? Is highest probability of not running out, so longevity. The ride you can accept, the fluctuations. And that conservative bucket, how many months of distributions that this will provide you for. So I'll give you an example. When COVID hit, by the way, I didn't see that one coming. When COVID hit, we had the lockdown, everything was very uncertain in the early stages. The biggest calls I got from clients were, is my income okay? If people are in distributions, right? That was the fear. The stock market's in free fall, the economy's shutting down, we're all, there's coronavirus, right? All of these things were creating a massive amount of fear. But the issue was that, and it was nice to be able to say, we have a year and a half in conservative holdings. We'll be fine. It's only 2 weeks. So that helps too. When there's volatility in the markets, when anything's happening, it really makes a difference to know how much of your distributions are in conservative holdings. Any other questions before I hop into economy?
How can you recognize market shifts such as market rotations before they are too far behind you?
Easiest way is when you have a big increase, and last year was a really good example of that, right? Last year was an amazing year for the markets overall, but the most of that driver was the Mag 7. If you're not familiar with the term Mag 7, it's your big tech companies. Let me show you a chart on that real quick. So last year, bear with me here. I'm going to just share this because it's more fun. You might get a little tired of looking at me. How much Kristina can you take? 45 minutes. Okay, you can see my screen?
It's now we can.
All right. So this is just a real quick chart. I have a couple of charts here. I may or may not share them all today. I will forward them to the AI team, and if anybody wants them, they can have them. It's not proprietary or anything. So that being said, this chart here really shows you clearly, okay? And this is gone, it's only going back to just 2021, right? So it's not long-term performance, but this is really when we started to see this big deviation. And what you can see here is the Mag 7, and here it just defines it for any of you not familiar with the term. So Meta, Amazon, Apple, Alphabet, NVIDIA, Microsoft, and Tesla. Those companies make up 40% approximately of the S&P 500. So when you have an S&P 500 fund and you think you're diversified in 500 companies, please remember it's market cap weighted. You are essentially 40% in 7 companies. And that is an important thing to keep in mind, because that goes back to that question about rotation. When you start seeing these big deviations like this, the rotation started last fall. That's what we did it, because it was clear. It's like, okay, tech is so overperformed, it's highly unlikely to continue. It just is. It's usually when you have this big technological advancement, there's this huge push into investing, stock price does that, everyone's excited, and then there's this consolidation phase. Is this digesting this new technology? We're heading into that now. And so anytime you see something like this, I don't know, whatever charting systems you use, that's generally a good time, because you see these are undervalued, these are overvalued. And it really helps a lot to understand that. So that would be a really good tracking thing. The other thing I want to add, though, a little bit is it's about time horizon as well. I mean, growth is growth. It will grow over time. The concentration is more of a risk. I don't think any of these companies are in danger of failing. It's simply when you run up that far, that fast, that far, the rotation makes sense. Another rotation aspect too, if you were, doing what we did, right, moving into more dividend paying stocks into other sectors, is really looking at what is the goal again? Do you want more income? Okay, they're going to look at good dividend paying, solid balance sheet companies. All right. If you're looking at total return story, then we want a little bit of growth option, but also some good dividend yield for stability. That you'll fine tune how you rotate, but on a high level, watch charts like this. That could be really important there. I'll stop sharing here.
What's your general recommendation on allocation based on the tax triangle, taxable versus tax deferred versus tax-free growth accounts?
Depends on your individual situation. Sorry. And I'll tell you why. It's because it's the distributions that you're going to expect to need from the account. So let's just make up the classic, I'm retiring at 65. How much money do you need? That's a big one. How much money do you need? That's the core of all of that. And then how can you get the most tax efficiently? So going back to what I said earlier, if you have a defined pension plan or some guaranteed source of income, those buckets would be a little bit different, because distributions from the retirement are required by RMD, of course, but any other distributions are optional. So remember, your taxable accounts, you're getting taxed either way. Whether you spend it or reinvest it, you're still getting taxed on, with the exception of tax-free or municipals and things like that. In your taxable account, when you take it out, it's ordinary income and in your state of residence, and based on, and California is a very, very progressive tax. It is easy to move fast up to the higher echelons. And sometimes it's like, you say, I just did this one little sale and now I'm here. It doesn't take a lot to get you up. In California, 40% of the residents don't pay income taxes. So you have a lot of pressure on the state getting revenue from those that do. It's just, that's the reality of it. So for you to be mindful in that environment, since you can't control tax policy, is how you do it. But I like to generally have a diversification of buckets. Now, for someone working and who expects their income their need for income is going to drop post-retirement, I generally push out Roth conversions. Now, unless they have a gap year, okay, they lose their job or taking time off or something like that, their household income drops, I'm like, it's the conversion year, right? Because we can get away with it. But a lot of times we actually, when we model it out, we're like modeling, okay, how much can we convert and keep you in the same tax bracket each year? And it's really fun. So let's say we want to keep you in the 24% Fed bracket. We can determine how much to convert, and then that grows that bucket. There's absolutely no downside to having a bigger Roth bucket, except for the taxes you have to pay to get there. So it does make sense for everyone. But it's nice to have, again, for most people, not for everyone, a really good diversification of tax-free, tax-advantaged, and taxable. Right, so it's a balance of that. And then again, the perfect world is you're pulling enough out of that biggest one, the IRAs, right? 401ks with the ordinary income tax is a floor, and then everything else kind of stacks on it. Another piece to why it matters is, let's say you have a big unexpected expense. You're like, oh boy, I didn't realize I need a new roof. And then you're looking at, where do I take that from? It's easier when you have choice. You can say, okay, we're actually can take half of it from your from your IRA, and you're going to still be in the same bracket. We're going to take the other half from your taxable account or your Roth account. So then you have choice, right? Every time you've been surprised, not just what's planned for, but also when the surprises come. So I hope that was helpful in determining that for yourself. But it is very, very individualized. It's very unique to each individual situation. Only other thing I'll add to that is your fixed expenses that you must pay. Okay, for Californians, your PG&E bill, your mortgage if you still have one, your property taxes, those ideally are going to come from more secure places in your portfolio. Whether again it's a guaranteed source of income or your pension, it's not just your portfolio, but it's really good to know that I'm not dependent as much on this, or how much am I dependent on my investments to meet my essential living expenses. And that also help controls the buckets. So if you need a bigger pull from your portfolios to meet your essential needs, your buckets are going to look different. By nature, we have to, because you don't want to sell good things at bad prices because you have to pay the bills. So that also will determine your buckets as well.
Okay, there's several more questions. For 401k or IRA, during RMD, will the distribution follow 24.5 years or income need during retirement?
I'm sorry, can you repeat the first part of the question?
For 401k or IRA, during RMD, will the distribution follow 24.5 years or income need during retirement?
Oh, the RMD is purely calculated on your age, the value of your account at the close of the previous year, and the age of your beneficiary. So it's literally there is no factor to your individual needs. And I'm talking about RMDs, what's required to take out. It is literally an IRS calculation. What you do with the RMD? Do you do qualified charitable distributions? You do something else as a personal planning decision. But yes, there's no factor into what your needs are or anything like that. It's not even a factor. The factor is expected longevity. So your age at RMD age, right, is a big one. The value of the accounts is a percentage of that. A rule of thumb, this is not, again, exact. So just if you're just throwing numbers around, you're far from RMD age. I usually say about 4% in the first year. That can change though, because that is a policy that Congress works on all the time. And then the other one is the age of your beneficiary. If there's a greater than 10-year gap between your beneficiary and your age, your distribution rates will be higher in general.
Will you explain active and passive ETFs and talk about relative performance of these?
Relative performance depends on your benchmark. So passive ETFs, if done properly, are going to benchmark the markets, right? So, S&P 500 funds, SPY is going to track the markets. Active, and you want to understand what active means, because there's so many ETFs out there with so many different strategies right now. Does it use leverage? What is its process to understand that? Active ETFs, there's so many different ways, but I'll just give one sense of it. Is the idea that they can rotate within to minimize risk. So for an example, let's say you had an active S&P 500, and this can't really be active S&P, but for example, active stock market. And it's saying, oh, we're going to do some rotation here, right? We're real tech heavy, the other growth in tech. So sometimes they will rotate automatically. You really want to understand what their strategy is and what their parameters are. Because where people get in trouble with all these ETFs is they don't understand the leverage within the ETF and they understand the risks. A lot of times people buy this, the yield is great and it's bonds, it's safe. And I'm like, no, not all bonds are safe. Like you need to understand, it may be perfectly fine, but sometimes people just look at yield and they think, oh, well, I'm getting this in my CD and look at this ETF over here. So understanding what that active process is. In my portfolios, I usually have a combination, depending on what the goal is. So it'd be something, look, I know it can be overwhelming. There are so many different choices. But it's definitely just understand anything that's active and what the methodology is to make sure it's a fit for you.
Do you agree that the current market degrading of funds and stocks is accelerating depletion of IRA accounts due to the sale of more shares to meet the requirements of the December 31st IRA account ending balance? I think this will accelerate early depletion of older citizens' IRA account to where they may outlive their IRA due to RMD withdrawals.
It's a big issue, and that's the reason that it's being pushed out. It used to be 70 and a half. and it went up 72, and now it's 73 or 75, depending on your age bracket. That's exactly the big concern. We're living longer and working longer. My mom turns 80 this year and she's still working, and she loves it. She gets to work remotely, so it's easy for her. People do work longer. And my mom's biggest complaint is like, I don't want to pay all these taxes. Why do I have to take distributions from my I don't want the money. That's a very common. This is coming up more and more again. And you're exactly right. The government wants their money. Their philosophy is you're retired, you need to start paying back in. This is not a wealth transfer vehicle to the next generation. That's why beneficiary or inherited IRAs used to be a lifetime distribution pre-2020. Now inherited IRAs have to be fully distributed in 10 years in most cases, not counting spouse. But that changed, right? So these poor, I should say poor, because certainly they're getting money, but I've dealt with a few cases where the beneficiary gets this $1 million IRA, and they're in their prime earning years, the beneficiary IRA, and they have 10 years. They have to add 100K to their income every year. So bye-bye money to the government. It's really, it hits them hard because it blows up their whole tax story, right? And also, too, as you talked about for retirees, it's really hard when you're forced to take money out and pay taxes on money you don't need. So this is a policy within Congress, to really keep revisiting that, maybe providing some options for the fact we're just living longer and working longer.
What difference does it make what tax bracket you're in? Only the amount over the bracket is taxed.
It does, but you have to look at that's what people don't see. So yes, the first X amount is at the 24%, and then the next Y amount is this, but it's the collective taxes that you're paying. So think of it like your effective taxes. And these are some pretty good calculators to do that. But yes, the bracket, anytime you go up a bracket, you're going to pay more money out. Just the reality of it. But you are exactly correct. It's not like the whole thing is taxed at 32%, right? Just the amounts that go over each bracket. And it is something to be mindful for. Is it a problem or not? Not necessarily. You made money, you're paying taxes, but you want to understand it, and you want to see if there's a strategy or an efficiency around it. But you don't want to twist yourself in a pretzel either, trying to avoid taxes at the expense of a quality of life, at the expense of what your plan is. Right? You just don't want to do that. You really want to balance it out. I always say awareness is the key. Awareness is actually more important than even the action you take. So awareness is the focus.
It seems from a tax perspective, income from rental investment would be better than from stocks, bonds, or ETF.
Income from, I don't quite understand
Rental.
investment.
Rental income.
Oh, rental income. Yeah, there are pros and cons. Biggest pro to rental income really is that depreciation factor and the tax benefits. And again, I own rentals myself, and having it in LLC, protecting your personal assets is key in most situations. Definitely consult with your legal advisor on this. Because a big risk of rentals is people often hold rentals in their individual names or in their trust. And if there was ever an issue, the cost of it, the litigation, the costs, any judgments have to be paid, they can come after your personal assets. So rental properties, generally, again, this is very general, so do consult with your legal professional outside of your assets for protection. Don't forget, it doesn't matter how much money you make, how little taxes you pay if you have an event like that. And rental income, so it does have those pros, but the other thing is it depends on, like I say, with people of rentals, what is your net income in a percentage basis? Take out any appreciation in the property, because that's uncertain. And also, if you depreciate it down low, you probably don't want to sell it, right? You're going to put it in charitable remainder trust, transfer it to your kids, whatever. But what you want to say is, and I think a lot of, probably not anyone listening to this call, because it's pretty sophisticated, but a lot of people don't really know that number on a percentage basis. And, over time, you're like, I'm making less than the CD with huge amounts of risk. Do I want to keep doing this? And it's something to evaluate over time. There's a lot of ways to also transfer property into 1031, managed 1031 type of accounts where you don't have to manage the property yourself. There's a lot of strategies around how to get out of real estate with a really, a lot of depreciation, a lot of costs, if it's no longer serving you. Also, if you are your own property manager and you're the one that has to fix stuff and you're the one to maintain the property and screen tenants, at some point in your life, you may be I'm done. I don't want to deal with this anymore. So there's not really an answer whether rental is better, rental properties are better or worse. It's part of a diversified portfolio. For some people, it makes sense. For other people, it makes no sense. A lot of times where it makes no sense is when there's heavy debt loads on it, because you're just not really going to make enough money with the level of risk you have. We also have a kind of movement over large parts of the country to really try to tighten up around affordability, around what you can and can't do, taxes on rental properties, and whatnot. So that is another thing it's constantly watching. There's a couple of counties that I have clients in that these things are actively being talked about, which can also again change. So even if you have a great plan, policy changes. And I apologize, I'm going over time, am I not?
Uh, she's
Sorry.
got till what, 10:15, 10:20?
Okay, I just want to make sure because I thought it was 45 minutes. It's okay, I can keep going. I just didn't want
Okay.
other participants sitting there going, wait, what about B? Come
I
on,
think they're planned to
cybersecurity is
start.
important stuff.
Yeah, I think they're planned to start at 10:20, so we'd break around 10:10.
Okay, good. I got a little bit of time. I felt bad because someone asked about the economy, but I want to make sure I'll have plenty of time for the economy. I got a short version, a longer one.
Okay, one last question and I'll let you get back on track. For taxable traditional and Roth IRAs, what should the relative spend down rates be given the intention to leave some inheritance?
That is also going to be very personal. And the reason for that is what is some inheritance? What are your fixed essential costs? So, obviously you have to take out enough to pay your essentials. The decision point is the middle ground. Do we travel less? Do we spend less so we can give more to the kids or to the beneficiaries? I should say kids. A lot of people, it's going to charity. So kind of looking at that factor and saying, okay, this is what I need to live. This is what I need to live, not feeling pressured. We have this funny little thing called inflation that pops up here and there, right? So if all of you can think about just for a moment what your costs of essentials has become since the inflation spike back in 23. Okay, so you've got heading on 3 years of this higher inflation environment. And inflation is not just the official CPI number, okay, which is a little higher than the Fed wants, but it's not 9.1% that we had in 23. It has come down a lot from there. But that being said, it's not just that. If you're in Northern California, your PG&E bill has doubled in the last 4 years for many people, right? Your costs of everything is rising. So checking in with that household budget, making sure that your numbers are correct. And so that's the essentials. You need that. That's non-negotiable. How long that will last will also depend on what your other costs are in life. Do you need long-term care? Are you going to need maybe a major retrofit of your home to be able to age in place? So all those factors have to be put in there, and that's kind of middle bucket. And the other one is, what do you want to do? And this is why I say it's personal. It's balancing out the want and the need and what's most important. So when you're trying to prioritize, you don't want to be, no, I shouldn't say you don't want to be. You would maybe want to consider being so restrictive, like I got to give it all the kids, and you're, living this lifestyle that's not meaningful, right? And not sustainable. You're not happy. You're feeling pressured. You're feeling scarcity, because the energy of scarcity is very destructive. So there's that middle ground with it. And I'll just say, to consider it, thought for consideration is a highly personal decision. Um, the kids have time horizon. They have time to grow their money independently of whatever you give them. So there may be consideration saying, well, but they're trying to afford a house and they really can't afford a house in this market. I really want to help them. So this is where financial planning comes in. Is there, you have lifetime gift exemptions. Does it make sense to gift any money to the kid, non-retirement money, of course, to the kids now to help them out during your lifetime when you can see those results? Why wait for the end of life? I have clients over 100. We don't know when it's going to happen. And so there could be a combination of wanting to give now and just making sure, again, that's sustainable for your needs, because the last thing you want to do is give your kids a bunch of money and then be knocking on their door one day saying, hey, I need help. I need you to pay my expenses. So there's that balance, and it's very personal. So most financial planning modeling can say you can safely give this much or spend, doesn't really matter, in your lifetime, and you will be fine financially. And the other part, that last bucket, is a balancing out of what your priorities are. If your highest priority is giving money to the kids over your own extra spending, then that would be one decision point. But we would always want to have a little wiggle room there because, in case, I'm sure this is all your lived experiences, life has surprises. Things come up that you don't expect, and you don't want to be financially pinched to do that. That answers the question.
If you're planning for a state that you're not giving to charity, isn't a traditional IRA or 401k the worst item to inherit?
Ooh, the worst. That's a somewhat subjective in the sense of a little bit of matter of opinion, but from a tax perspective, like pure tax or trying to hand money to the next generation, it's far less efficient than giving non-retirement money because of the current law, again, subject to change throughout your lifetime with different administrations and Congresses. As they said, they got 10 years to take it out. It's tax ordinary income. Just typically that when people inherit money based on usual longevities and whatnot, they're also in their prime earning years or shortly thereafter. Maybe they're also, I've had this happen more than once when someone's in R&D stage and they inherit an IRA. Oh, double whammy. It's like really hits them, right? It's like, oh no, I'm already overdoing the RMDs and now I've got this one on top of us. So it is. So if your intention is to give money to people, the humans in your life, and also to charity, it would be much more beneficial to have the retirement non-Roth. So IRAs, 401ks, 457s, or that money going towards charity because they don't have the tax implication. And again, general advice, not specific to any one individual, but just consideration when you're thinking about where I'm giving the buckets. I've done that in my own planning. I just optimized it. So, nobody got hammered getting a whole bunch of IRA money. A lot of that goes to, in 401k money, a lot of that goes into charities because I'm very charitably inclined in my planning. So do look at that and understand, but most definitely the best things that generally, again, this is very generalized advice. I know I have to keep saying that, but the regulators are really strict about it. Property is often, especially a property that's appreciated significantly, is really advantageous in many ways. The state of California has made it less advantageous in recent years, but there is a lot of benefits. The biggest one is the basis step up. So all of your taxable investments under current law, the basis will step up to the value on date of death. So it's less of an inheritance in many, not all states, is not taxable. You really want to understand your specific state. So for example, California and Nevada, it's not, but other states it is. And so you want to understand that as well, is that if your beneficiaries are inheriting money, and this is all done in California, it's a different story than if it's in Massachusetts or other states. Oregon, really good example. Oregon is a really aggressive estate tax. So that would even be with taxable investments or appreciated assets.
There was a question about use of Silicon Valley AAII semi-strategies. If anyone is using it, would you reply yes into either questions or webinar, and I'll make a comment later? Because I'm certain you.
Because I can't answer that question. Sorry.
I know you can't. That was.
I have no idea.
Okay, thank you.
But you guys can all geek on that because well, and so that's any other questions? Are we good there on questions?
There was a question regarding the pro and cons of long-term care annuities.
It depends on your situation and what your intention with your long-term care is. And also it depends on your cash flow. Like how much, I'm sorry, it's not cash flow, but how much liquid assets you have. So being very generalistic, there's annuities that have a long-term care component or rider to them. There's a cost. And so you want to look to the cost to benefit of that annuity. There's also the standard long-term care plans where you pay a premium. Those are good if you don't have a lot of liquid cash and you just need to make those monthly payments. The challenge to them is they get a lot more expensive as you get older. And what a lot of people do is like, I can't afford this anymore, and they cancel it. So you put all that money in for years and now you've lost your policy. Another one, and that's only if you have the liquid resources to do it. There's a lot of types of annuities out there. I'm sorry, not annuities, long-term care policies now, which again, I personally think is more attractive. It's you put a lump of money in. It could be for yourself or yourself and your spouse, depending on how you want to structure it. You put a lump of money in, and that automatically buys it. And these are approximate numbers because it changes depending on a few factors. but it automatically buys like 5 times the coverage from day one. So around that 5 to 7, it depends on the program. And the plus to that is you have to leave it in for 5 years. And if you change your mind, you can take it all out. So that's sort of cool. Net of anything you spent if you use long-term care. I bring that up because the other benefit to it is it pays a per day amount set for inflation, regardless of whether you have in-home care, you're in a facility, accommodation. And so it gives you a lot more flexibility. But the biggest part, biggest reason I like it, it's not a small lump. Depends on your age and health condition. Okay, but I would expect a high 5 figures for a lot of people. The other big advantage is the biggest concern people have with long-term care buying a policy is, what if I never need it? What if I pass away peacefully in my bed one night and that's it? All that money's wasted. But with that type of policy, there's actually a beneficiary attached. So whatever the value of that account is will transfer through as an insurance settlement. So the money's not lost, but it is locked up. So that is money that, yeah, it's growing by inflation or whatever. It's money you're taking away from other potential investments to do this, but there's a big peace of mind to it. So for those that have the resources, those are really good things to look at. And if you want to understand them better, one thing I say, if you have an insurance professional, I would say specifically, I'd like to see the options space. Sometimes it's a little challenging to the insurance people because they work for a company that they promote their product. And there's a world of options out there. We're required to carry insurance licenses because we're advising on insurance matters and planning, which is super cool because we can see everybody's policies and how much they cost. We don't work for anybody, right? Oh no, I love it because I'm just like, client come back and, like I said, I would say we can do it if you want us to, but we don't have to. If you want to do it on your own, you have a relationship with somebody. But whatever they propose to you, bring it back to us so we can look at it and just make sure it's not. Because I've seen quite a few times where it's like, oh my God, these fees are crazy. No. There's another option. Look at this. And it kind of helps people navigate. It's a very big spend, right? It's a very big decision. But I do like the flexibility of those types of plans and that the money is not lost. And that would be very good potentially for someone who's like, the intention is to give money beyond their lifetime. It's like, okay, well, if I don't need this, it's going to the bennies.
A couple other questions. Do you want to finish your presentation or take some more questions?
No, I'm good. I think the questions are most important. I can cover the economic stuff really fast, if need be. The questions I feel are most valuable because that's what people are here. They're taking time out of their Saturday to listen. I want them to walk away with, I got an answer.
Okay, the next one, QCD is maxed. How do you avoid additional tax on additional RMD?
There's no real solutions. If you're over 70 and a half, that's the beauty of the QCD, right? But once you maximize that, there are not really any other options, unfortunately. Government wants their money. And wish I had better news for you. At this point, there's none. Oh, wait, I'm sorry, may I add one thing to that? Possibly in your big financial picture, is there anywhere else we can reduce taxes? I would look at the tax return. I would look at everything holistically. I see sometimes people have mutual funds and taxable accounts. I'm like, oh my God, all these, phantom capital gains tax distributions. So sometimes efficiency, maybe, and again, ideas, maybe we're going to allocate more into California municipal bonds. Now, I understand California or any state's municipal bonds are very difficult for individual investors to do. The reason is that the stock market, everybody gets the same price. I buy it on the exchange directly. You buy it through your Schwab account or wherever you're holding your money. We're going to get the same price for doing the trade at the same time. Bonds, very different story. It's all about relationships. It's all about connection managers. It's all about connection issuance. So the bonds that are available for individual investors, like and I don't want to pick on any one company, it's the same for all, but it doesn't matter, Schwab, wherever, is usually the ones nobody else wants, right? Because you think of it this way, an issuer that's issuing bonds for a state, they want to sell quickly and efficiently. So the big blocks of those bonds are going to go into mutual funds, exchange traded funds, at your Vanguards, your Fidelities, your iShares, your First Trust, like they're going to go into all these companies, right? They're buying large numbers, Nuveen. And then it's going to trickle down into wealth management like us. They're $1 billion firm. So we get some pricing preppers, and it kind of trickles, and the bonds that are left because everyone takes all the good stuff. It's like, when you have Halloween candy and everyone's picking out their favorites, and then you just have all the dum-dums left. Sorry if anyone loves dum-dums, I was just picking on that. So that's a little trickier in that space, and that might be a situation where you do look for outside counsel, even if it's just for that one account, because it does make a difference. But if it made sense, you had some municipal, maybe you're reducing the taxable income, less income producing taxable securities more, and that will help with your RMDs.
Why don't you finish with the economy and we'll see if we have any more time for questions.
Okay. Okay. I'm going to be super quick on this one. And I'm only really going to just share, I think, one screen on this. I'll start talking about the economy and then I'll just show the one. A lot going on in the world. A lot, right? And anytime you have a lot of things going on in the world, it also creates a level of uncertainty. So I'm going to kind of take it a little bit hierarchical on this one as well, with what's most important and what we're watching and where the economy is likely to go this year and next. With a caveat is this is based on literally yesterday's data. So data as it changes will also change our projections for the economy. We have a pretty darn good track record at this. However, we don't know what tomorrow will bring. We have high probabilities, but those adjust. So imagine the economy is almost like each sector, each piece, all of the important parts of the economy, not what's happening in the media, not what's happening in politics, and all that's nonsense and noise. Data is what really matters. And what we watch for is something increasing or decreasing. And you can't do it month to month, right? Because you can get volatility. Look at your own portfolios, right? You get a lot of volatility, but if you do an inception to date, if you've been investing for a while, it smooths it out. So what we're looking for is a structural change. And we start to see enough of these pieces of economic data going from green, growth, to yellow, caution, right? Red, heading to recession, right? So it's kind of like how we model it. You look at that and say, now I want to tell you, you have a bunch of yellows, does not mean we're going to recession. We've had so many, the last true fully defined recession we had was after the financial crisis. We had a technical recession in 2023. And I'll define the difference quickly. A technical recession is 2 negative quarters of GDP. That is a recession by definition. However, for the government to officially call it a recession, there also needs to be a meaningful uptick in unemployment. And that's that kind of combines with it, because we had such a just not enough workers, right? Opening up post-pandemic, companies couldn't hire fast enough. Our employment numbers were unusually low, and it was just an anomaly, right? It was just the distortions creating the economy around the pandemic and the fiscal policy around that. It was just a noisy time, but because unemployment didn't shoot up, it was not officially a recession. But the market tanked, right? We had all of the other official components of it. So that being said, right now, I'm just going to go high level first. Right now, we're on the economy is we have some yellow. We're watching very closely to see if it's just noise, because we've had, I don't recall if it was 13 or 17, where we had a number of yellows since the financial crisis. Okay. And we had no recession. So a lot of times it's just watch, keep an eye. The biggest thing that we're watching now is really what's happening with employment. And the one thing I want to stress at this point, AI is a very, very, very small part of this. Most of what's happening in the employment market is structural. It is demographic. It doesn't matter who's in the White House. This is a demographic problem. These are long-term structural issues. We have a lot more people, retiring, a lot of people coming in the workforce. Productivity gains, not just through AI, but technology overall, has led to less of a need for a workforce. And there's a lot of factors going into that. What the important thing is how are wages rising in relation to consumer spending, and tracking that. There's a lot of fear in the media about AI is going to take everyone's job and everyone's going to get laid off, and we're going to have this big, issue. Historically, every time we've had any innovation change, going all the way back to electrification of the railroads, like we can go back a long ways, it's always the same trajectory. First, there's that initial enthusiasm. Yay, wow, it's going to change the world. Think of .com, right? And then there's this consolidation phase where it's like, okay, How are they going to make money doing this? And that's what AI is heading into right now, right? There's been an extraordinary spend. Now, we're not going to stop growing there. It's not going anywhere, and it's going to get big fast. That's not changing. But the disruption, historically, we tend to over exaggerate or over, use better word, the short term. And we tend to underestimate the long term, like 10, 20 years out. And that's probably exactly what's happening here. You know, it's not the world is ending, everybody's going to be laid off. However, what is very, very important, and it's so funny because I do a lot of talks to younger groups. I say that very important is that to be a lifelong learner, because jobs are going to change. Jobs are going to change through efficiency and productivity, and you don't want to be the person that can't adapt. It's going to make it very difficult. Some industries have bigger risk, especially tech, right? Because, you know, it's kind of say the programmers that made AI are now losing their jobs to AI, right? It's in some cases, right? If they don't have specific AI training skills or AI skills. Right now, I have clients in the AI space, they cannot hire enough people at very high salaries because there's just not enough people that adapted their skills and learn how to train AI, because AI needs to be trained. If you've ever worked with AI agents or anything, when you actually have to teach it, it's I don't know, it's like talking to a toddler that's all over the place. You have to train it, right? And most people don't know how to talk to it because it has its own language and it's kind of weird. And so you have those trainers, right, that are training AI to do specific things for specific companies or specific industries and don't have this big learning curve in a package. So there's a huge demand. If you ever want to have a whole list of the jobs of the future, like if you have kids or grandkids going to school, this is where we're heading. These are the skills you want. So even if you want to take classes in basket weaving or anything like that, but you also need these skills. Like it's going to be essential. And there are a lot of opportunities. So there's like every time we have technology innovation, same with manufacturing, with the big automation in manufacturing. Most people over time will transition into what's the new job. Industrial revolution, imagine that. I mean, women that used to be working with yarn and spinning all day and sewing, all of a sudden they didn't have a job, but you know what opened up for them? Office jobs. Office jobs all of a sudden opened up. So it was actually better for them. More pay, better working conditions. That was not available before. So it's not this all bad or all good. It is change. I am defining this period as disruptive abundance. So disruptive abundance, there's a word for today. Take it away from this. What we're heading into is disruptive abundance. And the key to being successful in this environment is resilience. Change is happening, adapt. Think of a surfer on top of the wave as opposed to one that's crushed beneath the wave. Adaptability. Things are going to change. Know, understand, you don't have to be an AI expert, but know and understand the impacts. Not getting into this fear-based mentality, but more about, okay, what can I learn about this? How can I understand this a little bit more? And so that too. And the final one is probably what all of you have already, curiosity. What if? How does this work? And the reason is that from the energy that it brings to you, it's more optimistic, it's more positive, and it's more likely that you're going to find a way to navigate the changes. This goes for life in general, but it really goes for now because it is disruptive within the job market, and it will be. At this point, though, I don't expect these worst case scenarios to play out anytime soon, only because of this. We're heading into consolidation phase, and there's always the consolidation phase. Because the biggest thing is how are they going to make money at this? Mag 7, great. How are you going to make money? You know, ChatGPT's not for profit. So it's really figured. There's a lot of ways. There probably more software will be developed, be an interface between the average consumer and the technology. It will happen, but the jobs will change. So I'll just stop there. It's a long thing on that. But the bigger disruption on the labor force is really tied to the demographics. And there's a lot more that goes into it. Final thing I'll say on the economy is that even before the conflict in Iran, I've been telling clients since the end of last year, we had amazing growth in the stock market. We will see volatility. Also, it's a midterm year. All midterm years are volatile. I have no idea why. It doesn't matter. Democrats, Republicans, a mixture. They're always volatile. So a rising market is always due to pull back. You see the charts? Up, pull back, up, pull back. It's normal. We're only 4% down from the highs. That's nothing. We were 19% last April with the tariff announcement. These are normal. 10 to 20% part of the ride if you're going to be all in equities. And so there's that, and there's also, I said, there's this big demographic shift in it, separate from and kind of combined with AI that's also creating that. So the watch thing now is really watching the consumer and really watching wages. So unemployment. We have this last report very quickly was disruptive because we had the government shutdown, we had a big nurses strike, and they have the new reporting methodology. So this last unemployment rate, we're like, it's kind of weird. We don't like it, but it's sort of, there's a lot of oddballs, so that the next couple of months will kind of show us. But I would expect to continue to see volatility in the labor market there. And the big thing to watch is that unemployment, consumer spending, consumer incomes. The last thing that I'll say on this is a little bit about government policy. Despite all presidents' best intentions, they have very little control over the actual economy. Most of their policies don't take effect until years after they leave office. Whether they lead to recession or lead to growth, they don't. And I'll give you a real quick recent example. Biden passed the CHIPS Act. They're still trying to build the factories. They're still getting permits. That was 2023. That's nice. Well, it takes time, right? Trump wants to have this big investment in America and building factories and whatnot. This takes time. And the economic effect of it takes even longer. So things that Biden did won't be seen until the future. Things that Trump does won't be seen in the future. So when you hear these policy things, even if they're well intended, it can take a while. The financial crisis was driven by policy that happened, oh my gosh, like 10 years, about 10 years before the crisis. And that was well-intended people in Congress saying, we just want to make housing more available and affordable. It was like truly from the heart, well-intended. More people should be homeowners. We just got to make it easier for you to be a homeowner. So we're going to lower the lending standards. But that didn't take fruit into a crisis for almost 10 years, 9, 10 years. So I'm going to stop with that. I just want to be very mindful of time, you guys. I'm so passionate about this stuff. I can talk forever. So let me take a breather.
Okay, we will take a break at 10:20 and restart at 10:30 with the second presenter. There's several questions pending. Midterms are volatile, but do they end well? Do they end well for the year?
Generally, yes. One exception was, I believe it was 2000. I'm trying to remember now. Remember the hanging chads in Florida? It was Bush and Gore. Yeah, that the market did not like that. It's like, wait, what? We don't have a president? That was a little. Nowadays, it's less so because we're just used to that kind of craziness happening around elections. But that was one year where it was election year and the market did not respond positively. Usually, it's really odd. It doesn't matter if it's Democrats or Republicans or the mix. The markets love the most split Congress because there are not going to be as many big policy changes, and markets hate uncertainty. So they're not, markets are nonpartisan. They just don't really care about who's in office. Policy driven though. So, and I'm not telling anybody what to believe politically, or a caveat to that. I'm just speaking economically. If something happened and we started lurching far to the left with a more socialist philosophy in Congress or the presidency, that will disturb the markets. And it's simply because it's free enterprise is what drives the markets, right? And if that gets concerned, I'm not talking a little bit, I'm talking, more towards socialism. That will definitely disturb the markets. I don't have time today to get into national debt. That is going to be your big crisis situation. That's coming up this next decade. So just to let you know, next couple years, volatility, 28's looking amazing at this point. As we coast in the 2030s, I'm not sure when it's going to be yet. We're going to have some pretty big reckoning that investors are going to be prepared for. But yeah, I hope that helps on the economy. So if we have a clear election, in other words, it'll take a while to decide if there was close elections. Ultimately, the market usually responds favorably to that, just because certainty is there. Like, okay, we know what we're dealing with for the next 2 years.
What is the name of the kind of long-term care policy you were talking about that had beneficiaries? The one where you,
yeah, I can't shoot. I should have my financial planner on here. I can't think what it's called. Let me see if I can follow up with you and get the actual name for it.
okay,
But it's kind of like a long-term care insurance hybrid. And I'm not promoting any one company, but I think there's quite a few companies that do them that are very big names. Because remember, one thing is you really want to make sure that the company has the solvency to meet their obligations. So most insurance companies, it's very easy to see their credit ratings and whatnot. But I apologize, it's not coming to me right now. I want to say it's like a premium pay or something like that. You just put it all in and you're done. And I want to get the terminology wrong because there's a lot of different stuff out there.
There's a couple questions regarding gold. I'll merge them. Thoughts on gold and gold miners and the direction of the dollar. Um, should we be moving money into gold? Is it safe to hold ETFs like GLD?
It depends your intention with your gold. Is it an investment vehicle to make money, or is it a hedge against major economic disruption? So if your concern is major economic disruption and you want to have some money in the physical gold, certainly I'm not going to give anybody advice to what percentage, but I usually use 10 as a starting point of your liquid assets or your assets overall. That's a personal comfort level, but the downside of physical gold is it's not easy to sell it. If you sell it, just take this, you're going to pay a premium when you try to sell it. And so you really think it's more of a long-term hold and hedge, and you want to make sure you have it stored in a secure location because if someone stole it, obviously it's non-traceable. So there's advantages to that as well, but I say not too much money. And gosh, please make sure that somewhere in your trust or with your attorney or with the trusted person in your family, they know where the heck you put the gold. I'm very quickly going to tell you, I have a client lived in the Central Valley in California, older gentleman, and he told me, I put all my gold in the walls of my house. Nobody will ever find it. And I said, I'm just going to call him dude. I said, dude, your kids don't want your house. I know they're my clients and they don't want your house. You know what they're going to do when you pass? They're going to sell it. And someday down the road, someone's going to do a remodel project and go, woohoo. So really important if you have physical anywhere that there's some, that you're, whether safety deposit box or safe or any other location that people know about it, because it's not as trackable as some of the other investments. So with IAU or GLD or any of the ETFs in gold or any of the metals ones, it's two things. One is a market timing, market trading thing. I want to hedge, I want to have some gold. It's more tactical. If the whole system goes down, everything goes down. Like seriously, the loss of your ETF is the least of your problems. So I don't really see that as a really meaningful concern to have in it, but you can always split the difference as well.
Some pundits believe that the prolonged bear market is on the horizon based on a 100-year Elliott wave. Do you follow or believe in the Elliott wave?
All indicators that we use to track portfolios, they're all different ways of measuring energy, which is fascinating. When we get into that, it almost gets into quantum physics at some point. So the Elliott wave is fairly in line with what we're seeing based on the trajectory of the US debt and when the reckoning comes. So when I say imminent, I always say, imagine this, you're on a beach. You see dark clouds far, far, far away over the ocean. You don't pack everything up and run home. You keep an eye on the clouds. So yes, in the 2030s, it is highly probable, based on just math, right, that we are going to find ourselves in a pretty significant prolonged recessionary period. And it's going to be pretty bad and ugly. And it's probably going to go on for about 6 years or so. And so when the indicators start to say the clouds are building, they're coming close, that's a time to take action. But again, you don't want to pack it all up now because it's not in the next couple of years. It is really, but it's not that far away either. So it's something to be mindful of. I can't say timing because we have to wait for the indicators to start to line up. But it's largely driven by the fact is that neither under current form, it could be something different in the future. Politicians are not rewarded taking stuff from us. Politicians are rewarded by giving us stuff. Perhaps Democrats want to be given different stuff than Republicans, but it is all about that. And what politicians are not rewarded to telling people, hey, we got to go on a diet. Less spending, less spending. It doesn't make them very popular. And then they lose because the other party says, oh, you're not giving to people. It's a game. And until we can get a bipartisan focus on the importance of this, and if it's anything like United States history, we're going to be pushed up against a wall and then they're going to solve for it. So I don't feel, I mean, look at the attempt with Doge, right? I'm not saying it's good or bad, but the attempt to rein in government spending, didn't end well because there's so much entrenched way of doing things in Washington. It is not very flexible and open to change unless forced upon them. Because it's basically in economics we call it misaligned incentives. Yeah, the incentive is for the politician is not to take the punch bowl away when the party's going.
I'll take one last question and then go to the break. How do you advise 30-year-old couples with kids about life insurance?
That's a good one. Well, they're all good ones. So this one, it depends on this factor. Life insurance, now assuming it's not an investment vehicle. Okay, there's some tax and investment investment, but 30-year-olds with kids, probably you're more looking at loss of income, right? So if I'm going to make some assumptions here. I'm going to give two stories because I don't know. Let's say there's a primary breadwinner, and there's one person staying home with the kids, right? Or working less. Then what you need to do in that life insurance policy is ensure the life of the person working and earning income to get enough money. The insurance should be high enough to do whatever's most important. So maybe you say, I'm just going to just do a nuclear family here to make it simple. Say both were working, kids coming along, the wife, steps back and stays at home and now completely dependent on husband's earnings. Okay, so we want to insure his life and we want to insure his life enough to cover any debt that she won't be able to stand her own because something happens to him, she's still got to take care of kids. It's not like magically she can go back to work and earn money. We've got some young kids here. So really earning enough that at a bare minimum, the bills can be paid, right? Even better if qualified, depends on their income and how much money you need. Can you pay off the mortgage, right? Can you pay off debt? Because that'll give her some breathing room so that the policy is enough to pay off or even pay significantly down the mortgage, but there's also money to live off of. Then she can manage the household budget until the kids launch. And theoretically, or the kids get old enough that she can do part-time work. So of course, all insurance has costs. 30-year-olds, great. You're generally in great health and easy to insure and pretty cheap. But I would just do that calculation. If the unthinkable is to happen, what do you want covered? And start there with the insurance policy. Term policy is fine. It'll be a lot cheaper than a whole life or universal life or any of these more complicated vehicles. Again, if you're not using as investment vehicles, just protecting that source of income with in that situation, right? And then you just basically have that guarantee that if anything happens, you're going to be okay financially. If both are working, husband and wife are both working, you're probably going to insure both lives. You just say, well, he's the primary breadwinner, she's just earning extra money. Yeah, great. But if she has to go to work full time, who takes care of the kids? You're going to need childcare. It's the same issue. But I tried in keeping costs down. I generally more insure life. Now there is one other wrinkle that I actually do a lot when the financial resources are there. Don't forget, it's not just working and earned income. If she's providing childcare for the kids, you can calculate the value in her life of what childcare would cost for a married kid's life, and that would be the insurance on her. Because if something happens to her, he's going to need to get childcare. So I just want to make sure it's not just about how much you make, it's also the value, financial value you're bringing to the family. I hope none of this sounds cold-hearted. It's not like anyone's life is money, valued on money. I'm just saying how it's an efficient planning tool and ways to potentially keep the cost down, but also having that peace of mind.
Thank you very much. It's been very interesting and informative presentation.
Thank you. It's a lot. And my highest intention is everyone that spent time here today got some value from this. I will wait to hear if there's any follow-up information that's needed, anything like that, just let me know. Just shoot me an email. Happy to get it. I didn't have a chance to get into global oil prices, but maybe I can say very quickly. We're probably going to be even with the conflict, we'll probably see 70 by the end of the year. It takes a couple of quarters to wean this out. Oil and gas is much less of an average household budgets now than it was years back. But I did bring that up because a lot of people are asking what's going to happen with oil prices. Highest probability. Anytime you have a conflict or a disruption in shipping, then obviously it's an unknown, but based on historical, highest is 70. Sorry, I realized that was one of the things I was supposed to talk about. But going forward, yes, if anyone has any questions, want more information that kind of better help you. And also, even if you have just questions on your situation, sometimes it can go a little more granular when I can ask you questions that you may not want to share in a public forum. I'm happy to, I'm past the point in my career where I'm working for a financial need. I like helping people. Just know that I can't give you specific investment recommendations or advice as a fiduciary if you're not a client, but I can give you stuff to help you build your portfolios.
Okay.
I got to
Thank
get you
you.
off the cyber. I got to get you guys onto cybersecurity. So,
Okay.
hey,
Thanks.
thank you
Thanks
for
very
doing this.
much.
I think this is a huge help to people doing it on their own to have this resource. Really just a place, a community to share with. And I think what you guys are doing are great. As long as you got some great speakers. And if there's interest in the future, I can't always do it, but when I can, I'd be happy to hop in if there's any topic you want me to cover.
Thank you.
Okay.
Thanks.